Welcome to the Delaware Mortgage Rate Weekly Mortgage Market Update for the week of May 5th, 2014. Hello, I'm John Thomas with Primary Residential Mortgage, here to give you an update. Well, last week was definitely another great week for Delaware mortgage rates. If you look at the bond chart on the screen, you can see the big green candles up all last week. That means the bond market rallied. You can see the short-term trend with the black arrow there is for mortgage bonds to continue to rally up. So that moved Delaware mortgage interest rates lower. So we're going to recommend continuing to float your Delaware mortgage rate to see if the bond market can continue to rally. So start the week floating your Delaware mortgage rate. So let's dig into what happened last week. The first big report came out on Friday. The Labor Department released the jobs report for April 2014, and it showed 288,000 jobs were created for April, above the 205 in March. So that was, on the surface, a good jobs report. And then the unemployment rate also in that report ticked down to 6.3%. So again, that's the lowest reading since September 2008. So it looks like good information coming out of the jobs report. So the bond market should have sold off. But when you dig into that report, the labor force participation rate actually dropped to 62.8%, back to a 35-year low. This shows the number of people that are actually 16 years and older eligible to work. They're actually working in the workforce. So that goes to show that the drop in unemployment to 6.3% was not because we had people back to work, but we had over 800,000 people dropping out of the workforce. So that's why the number dropped. And then when you dig into the jobs that were created with this, 288,000 jobs, they were service-related jobs. They were not professional jobs, not jobs that we need to get the economy to recover. And that was seen earlier in the week. We saw the weekly initial jobless claims come out on Thursday, the day before, and they jumped higher by 14,000 claims, up to 344,000 claims for the week. So that was not good news right there. That's showing that the people looking for work, the claims are increasing when they had been decreasing. Then we had a reading on the GDP. First quarter 2014 came out very bad at 0.1%, down from 2.6% from the fourth quarter of 2013. So a bad GDP can be explained by those 280,000 jobs in the jobs report were not professional jobs, which would have added to the GDP, more service level jobs. So we've got a long way to go. We got to get that GDP up to have a good recovery. And then the Federal Reserve had their meeting last week on Wednesday, and they announced that they're going to continue reducing their bond buying purchase program called QE3. So they dropped it by another $10 billion per month. So we have dropped from $55 billion per month down to only $45 billion per month starting in May. And that's a combination of mortgage bonds and treasuries. The Fed's goal is to be done buying assets by the end of the year. So as they pull back buying, we're going to see effect on rates, and rates will start to move up as the Feds stop buying mortgage bonds. So be on the lookout for that. The predictions have been by the end of the year, rates will be in the low 5%. So if you're looking to buy or sell, buy or refinance, now's the time to do it while rates are at all-time record low. Then we had the Case-Shilling 20-City Home Price Index for February 2014 come out last week. That showed a 12.9% year-over-year increase from February to February. Now the index does show appreciation slowing and is looking at close to a 10% appreciation in 2014. So it's still a great time to buy. You're still going to get some appreciation on your home in 2014. In the local news, the next free first-time homebuyer seminar is Saturday, May 17th. That's in Newark, Delaware, from 10 a.m. to noon at the Christiana Hilton Hotel. You can register for that event by giving us a call in the office 302-703-0727 or online www.delawarehomebuyerSeminar.com. Look forward to seeing you guys next week.